Welcome to the daily update where I'll go over the action in the market for Friday, February 21st, and we'll see how things look for Monday, February 24th. Pretty ugly day. Now, it was options expiration. Some of it could be explained away by that. And we saw a real shifting lower to some strike prices that were either way in the money and started to come out of the money, or put options that were out of the money that started to come in the money. But it was a broad-based decline. In fact, we've dropped below the 20 period moving average. So we've turned negative in the short term. The 50 period moving average is holding for right now. We were able to close above that, and it also provided support. So the intermediate term is positive, but showing some weakness, and the long term is still positive and looking solid for the time being. As long as we stay above that 50-day moving average, that really won't do much to the long term of the trend here. Okay, so right at the open, and there wasn't a gap this time. We had a lower open, a quarter of a percent or so, but we've seen that earlier on this week, and the market just kind of drifted and ended up improving. We'll have to see. Is this a one-day wonder or the real beginning of something? And you can make a case for either side. That's why I do these videos every day. We evaluate things where they're at right now. Then we'll come back after Monday, reevaluate things. We'll be watching the smart money. Are they coming in and buying? They really didn't do anything in Friday's session. Our growth to value ratios are showing some weakness. So yeah, there's some weakness that's coming into the market, but are we actually switching over to a more negative type of an environment? So we did have a lower open, and we were down below the daily pivot at 6112. Then we just kept going. We dropped below 6100. S1 was at 6090. We fell below that. And this should be S3 here, which I had to calculate myself. We went down, actually, S1 and S2 are correct. We did get down to S3 at 6012. Okay, so we fell below the 6100 level, but the 6000 level is still holding for the time being. Then there was really no bounce. There wasn't any kind of, oh, let's buy the dip. No. They tried a couple of times and we stabilized as far as price is concerned, but we closed pretty much at the intraday low. And so, yeah, it was a negative day, and it's done some technical damage. Then we have to see next week. Are they going to come back and do some buying? Was this overdone? Was this related to options expiration? Or are we seeing a general shift over to the negative side? We were down 1.71% on well above average volume. A lot of that is because of options expiration. We are negative now in the short term because we're below the 20 period moving average. We're still positive in the intermediate and long term. Interest rates are going down, and that may give some support as well. We're falling further below that 4.5% level with the 10-year yield. And some of this could be the political things going on in the US with Doge and executive orders and all these things that are happening so quickly. Other things could be more fundamental to the market itself. There's been some concern that we've been seeing for years now that, oh, maybe the market's overvalued. Well, anytime we start to go down, this is brought up as part of the equation. But like I said, this is going back many years now. And some of the economic reports that came out are showing that the sentiment isn't as positive. Their folks are worried about inflation going forward. And that's what we're going to see with a lot of these changes coming in with the executive orders and Doge and all these things that are coming through. And it's not just coming in and cleaning out. I mean, there's some real changes that are going to need to take place. And people are now starting to realize, oh, that might mean something actually different is going to be happening here. And when you get out of the status quo and what people are used to doing, that's uncomfortable. And people are a little apprehensive about that. And this applies to companies, it applies to politics, it applies to all the different areas of life. Okay, so some comments. It was a broad-based decline on above average volume. It was options expiration day. I think I've said that four times now. And we were able to close above the 50-day simple moving average at about 6,010. So that is holding for right now. And there's some other support levels that are holding. Other support, we're getting close to seeing that disrupted, especially with the small caps and the mid caps. There are concerns over growth. Okay, are we going to see this economic growth? Is the economy still going to stay strong? The market is not really anticipating that we're going to go into a recession, but that's why we watch things and evaluate them day after day after day to see is that starting to look like it might happen. Right now, no, it just seems to be everybody freaked out on Friday. And we'll see. Is it just going to be a one-day wonder, or is this the beginning of something that's longer term? And then valuations, as I said, this has been going on for years now, and they suddenly decided to freak out about it on Friday. United Healthcare, they are the biggest component, or I think Nvidia is now because they've been included in the Dow, but a very big influential company. They didn't come out with earnings, but they were down 7.2%. There was a report in the Wall Street Journal that the Department of Justice is launching a fraud investigation into their Medicare Advantage billing practices. And when you get a big, influential, powerful company, especially with the new administration, this is ruffling a lot of feathers. And is this the beginning of something that could spread, or is this just confined to United Health itself? And of course, it was down, which it dragged the Dow down, and then other things started to take on more of a negative flare, and that pulled everything else down as well. On a short-term basis, though, we're still extreme, but it's our long-term stochastic. Now, the stochastics, we have short, intermediate, long-term. That's also confined more to the short-term time frame. We're rolling over with the short-term, intermediate short-term, but we're still extreme positive, excuse me, with the longer short-term stochastic. And we're already extreme negative with our Stoch RSI. Now, it wore off after Thursday. It had been extreme positive after Wednesday, and then now it's down to extreme negative. That you can see how touchy this indicator is. In the intermediate term, we're coming down, but we're right on the border with the Sean trend meter, and it's coming down. And if we were to tick down a little bit more, it wouldn't be on this list, but it's just barely at the extreme positive line. No change to the overall scenario. Interest rates are actually coming down now, but now the market is kind of shifting and focusing on some different things. At least they did on Friday. The dollar was up, interest rates were down or at 4.42%, where after Thursday we were at 4.5%. And that's been that line in the sand between positive and negative. And again, it's relative to what's going on at any particular time. A couple of years ago, it might have been 2.5%, and the market freaked out. 10 years ago, it might have been 7.5%, and the market would have freaked out. It's just, I was noticing that we were going up with interest rates and stocks were still going up. This is going back into 2024, and the two are kind of going up together. Well, once interest rates got to the point where the market was feeling uncomfortable about interest rates going up, it was right around the 4.5% level. And then sentiment is now negative. We were neutral at 45. We ticked all the way down to 35, which is now looking negative. And instead of having a non-trend that's positive, we're now in a non-trending environment that's negative. The red line has crossed above the green line. We're still seeing the ADX continue to go down in the intermediate term. It's still trying to level off in the short term, and I'll show you both of those charts. And with the down day, our bias is negative, and I've changed our momentum back over to negative. Now we could get that back if Monday ends up being an up day, which is not necessarily positive on a seasonal basis. And Mondays and Fridays have been kind of negative so far in 2025. But if we get that back, the momentum, which are the last 2, 3, 4, 5 days taken together, we could switch that, or this could continue to be negative if we see more weakness. All right, we did get the S&P Global US Manufacturing. I don't have charts for this. These are not really that influential. There's other PMI reports that are very influential. This is not one of them. Still coming in above 50. When we are above 50, that shows expansion. We came in at 51.6. Last time it was at 51.2. So there is some expansion on a global basis. This is what concerned the market a little bit, but this usually doesn't have that big of an impact. You look at the services, which is the non-manufacturing type of parts of the economy, we dropped under 50 there, where we had been at 52.9, showing growth. Now we're at 49.7, which is showing contraction. And some folks are citing that as freak out mode, but this really doesn't have that big of an impact. Existing home sales came in a little bit stronger than expected at 4.08 million. They expected 4.06 million, but down from the 4.29 million that we saw last time. Consumer sentiment, this is also being cited as part of the problem. We declined down to 64.7, where last time we were at 67.8, and they were already concerned about the fall to 67.8, which is what we saw before. And now to see this even worse, because there's a preliminary reading that comes out 2 weeks ago that was at 67.8, and then they do the final reading, which dropped even further down to 64.7. And that does have an impact. And I have a chart to show you of that one here, where we take the total reading, which is in blue, and that's really going down. We're seeing how people are feeling right now. That's the present, that's the purple line. People are not feeling good these days. There's a lot of shifting and changing going on. And then expectations are how are they looking out into the future? And we're seeing a drop in all three of these areas. Then looking at some Isabel Net blog charts, this is looking at home equity ownership and then comparing it to the S&P 500. And there's some logic there that people are buying a house and their house is increasing in value. We're typically seeing an increase in the S&P 500 at that same time. And then this is kind of convoluted here, and I think it's a little premature because we did have an up January, which is typically positive in the bigger picture when you take the whole year into consideration. But then there was all these charts starting to come out to say, okay, what if January and February are positive? And it shows you what the average and the median is and the percent of the time that we were actually higher. And it's pretty positive. But even after Friday, we still have a week to go with February. There's no guarantee that it's going to be positive. So that's why I was saying these charts are coming out a little quick. This is also showing that so far in 2025, Monday and Friday have been the weakest days, which is kind of the opposite of what we were seeing in 2023 and into 2024, where Friday and Monday were the stronger days. Then the announced buybacks. This is also seen as something that is positive when a company comes out and says, we're going to buy back our own stock, because that means, well, we have confidence in our stock. We wouldn't be buying it if we thought it was going to go down in value and if the company was really in trouble. And it also takes shares off of the market that makes them more precious. So that has a positive impact on the share price of those companies. Well, what this does is this breaks it down by the 11 sectors that make up the S&P 500 and goes over the last 3 months. And we can see that there's been some buybacks in the financials because they've been stronger lately. In a bigger picture sense, they still have a ways to go, but in 2024 and into 2025, they've been doing really well. And when you look at charts all by themselves, yeah, they've been one of the stronger areas. Even longer term, though, they still have making up to do in that. And then a lot of buybacks in healthcare, even though they've been getting pummeled lately. And this breaks it down. And this is the percentage of the market cap and how much of an impact it has on that particular sector. Okay, hedge funds trim positions on the net in the Magnificent Seven during the last quarter, the fourth quarter of 2024. This just shows Tesla, Microsoft, Nvidia, Meta, Google, Apple, Amazon, and that hedge funds. Now, as I usually say about hedge funds, they might be the big money, but they're not necessarily the smart money. So sometimes we can see really big things happening that we think might be the smart money when it's actually just a hedge fund doing a lot with a lot of money. And we kind of have to try to be able to distinguish between the two because there are a lot of hedge funds that do very well. There's also a lot of hedge funds that don't do very well at all and end up going out of business. And it always amazes me when somebody comes on to do an interview or they're citing somebody in an article and they talk about this person being a former hedge fund manager. It's like, okay, if that person was so good at what they're doing, why are they a former hedge fund manager? It's kind of, anyway, hedge fund. All right, and then the adoption of AI could reduce labor costs, and we're seeing a big shift that way too. And that what's that going to do? Just like the car changing things, how the TV, it was going to ruin the cinema, and but yet we still have both. And people listening to stereos, oh, that's going to ruin the radio. Yeah, again, we're going through that kind of period when it talks about AI, and yeah, it could reduce labor costs and increase labor outputs. But then what's going to be the new shift? Where are these people going to go into other areas? For example, if somebody works in a warehouse where all they have to do is move things from point A to point B, okay, they have the skills to be able to do that. They can drive a forklift and do the things that are needed for that. Well, over the last probably generation or so, that same person has now had to learn how to work a computer because they're not only shifting things from point A to point B, but they're also tracking it in a database. And so those skills have had to be enhanced to meet the needs of that particular job, which was probably seen as requiring less skills 40 or 50 years ago, now needing more skills to do that because technology is involved. What's going to happen here with AI? We don't know. We don't know how these shifts are going to actually take place. But this gives an idea of what the productivity is going to look like. They see a lot of productivity in Hong Kong, and then the higher potential for AI adoption, and they're just trying to track this along the way here. Okay, then 51% of the large cap mutual funds are outperforming their benchmark. Well, somebody didn't tell this chart about Friday, but that's actually more positive because that means that the rest of the stocks inside the S&P, they're they're doing better than the S&P itself, where a lot of fund managers out there and hedge fund managers and ETFs and so forth, the benchmark is the S&P 500. And if they can't even beat that, you might as well just get into the S&P 500. Well, we're seeing a bit of an edge here right now. Okay, and then this really is not applicable now. It would have been applicable before Friday's session. This is looking at all of the options and what their perceived value was at right before Friday's session, and a lot of these were getting ready to expire, and this is why we saw a lot of shifting around on in Friday's session. I didn't really spend any time on Twitter. I've been too busy looking at the charts I use for the video here, but this is the intraday chart where we didn't really see a gap at the open, but immediately came down below S1, tried to stabilize, nope, broke lower down below S2, and then we were pretty much in free fall until we got down to S3. And this is why I put on the YouTube community tab, I put this chart, it's already up there for Monday's session, and we know these levels before that day. So Monday's levels are already there, and you can use those as kind of guideposts during the day to see if we're going up or going down, if we're hitting support or we're hitting resistance. Now, the software that I have through stockcharts.com, it only calculates to S2. I have to use a pivot point calculator to execute S3 and calculate that one. And so that's why it looks a little bit different here. But these levels are very important. And even though I'm not a day trader, I'm really watching these things because we can get some real clues about what's happening in the market by looking at the intraday action. And it was weak all the way, and we ended up closing right at the low for the day. There was a feeble attempt there for a while at a bounce that just didn't take hold. And so we ended up dropping back down going into the close. And this also, we're pretty much unchanged now as we get set to close for the weekend. But there wasn't really anything happening that was seemed all that out of the ordinary before the market opened. We were actually showing an improvement with the futures, and then everything opened and everything tanked after that. So we are seeing a real weakness here. We're still slightly positive with the blue line above the red line when we look at the intraday growth versus value. And this was not a good week for growth. We've been seeing some weakness, and I'll show some other charts to back that up here. We need growth to do better. Now, the smart money had been coming in and buying growth. Are they just sitting back and just going to wait and then eventually be able to take prices back higher? Or are we starting to see a shift away from growth and more into value? When we get into growth, that's positive for the market, and the market is anticipated to go up. When we see a shift back over to value, the market is becoming more defensive because there are money managers out there and mutual funds and ETFs. They have to be invested all the time and they have to be in the stock market. So if they're getting these red warning flags coming up, they've got to put their money somewhere. They can't go into cash like you or I can as individual investors and just ride it out. They have to be invested somewhere. They're mandated by that. Their prospectus says they have to do that. And so they find those things that will go down the least if we are turning more defensive. And that's what we saw back in 2022. Are we seeing a shift now? Not yet, but if this continues longer than just the few days that we've been seeing it, then yeah, we'll have to shift our attitude over and change to being a little bit more defensive. So the blue line is still above the red line, but the blue line's really been coming down over the last few days. And we're also seeing a real drop off here. This was a really nice uptrend going back to the end of January, and then we started to level off, and now we're seeing some weakness again. If this continues to fall, that's going to cause some more concern. End of day, I mean, growth just got hammered. Everything was red. Now, if you're not used to this particular chart or if you're new to this video, over on the right-hand side, these are the growth parts for the large, mid caps, and small caps. And that those areas got hammered the most. Over on the left-hand side, these are the value areas, the more defensive areas. And even they were down, but down less than growth. And then in the middle, this would be the SPY, this would be the mid cap ETF, and the small cap ETF. So this is the market itself with value on the left and growth on the right. Everything was red. Okay, and we were looking okay here. We were going up with the small cap growth to value. Now this is an end of day chart, but then we started to level off, and now we're coming back down to the 200-day moving average with this ratio. Are we going to be able to bounce up off of that? This did provide some support in the past, and we bounced up from there. Is that going to happen again this time? And you can see where the small caps, which going back to the beginning of 2025, they're down on the year now, where they were supposed to just take off and go to the moon. That's not been what's happening, or has happened at least to this point. And mid cap growth to value, also looking pretty solid here, breaking under its 50-day moving average, still above its 200-day moving average, still in an uptrend, but this index has pretty much gone nowhere either and is now looking more negative. And we're even taking a bit of a hit with S&P growth to value. Still in an uptrend, but falling under the 50-day moving average. Now we could bounce up from this, and we're still looking positive here. But if we see more follow through weakness with this ratio, that's going to cause some more concern. Okay, and coming back down into more the middle part of the rainbow when we look at the growth versus value ETF. And this has been lagging behind now, going back to late 2024 into 2025 so far. We haven't been seeing any real explosive growth with this growth to value ratio here. So this has been giving us a little bit of a warning sign, but our other charts were actually looking more positive. So we were just kind of noticing this. Well, if we see more weakness here, that's also going to increase our concern. And discretionary to staples, strong area of the market going back to last summer, falling below its 50-day moving average. Are we going to be able to recoup from there? And this is one of the times where even those staples, you look at it all by itself, they're in a downtrend, but they just shot up like crazy in Friday's session, where discretionary didn't fall all that much, but it did fall below its 50-day moving average. And that's when you compare the two, the ratio down here, that's why we're seeing it really dropping off. Large cap growth. This had been holding above its 50-day moving average. Not now. It's dropped below its 50-day moving average. So this took a pretty big hit in Friday's session. But we've fallen down below this before, and we were able to bounce back up. Now, if we continue to fall, This is the 100 period moving average here in green. That will be more negative if we continue to fall down to that point. As far as our trend, we had been defaulting to positive because the green line was above the red line. Not after Friday. The red line's now going up, the green line's going down, but we're still not trending right now. We're well below 20. That's a static number that I use, and I determined that number. I read books on the ADX and they say 25, 30, 22, whatever. I settled on 20 when it applies to the S&P 500. That's a static number. And then I put a moving average on here that's dynamic, that changes with the ADX every day. And when this is going down, that just means there's a weakening trend. And that's why I say we're not trending. Well, is this the beginning of a downtrend? If we start to turn up and go above the moving average and the red line keeps going up, that could signal a negative trend. And we're seeing a little bit more stabilization here in the short term. Now, I show the first chart, intermediate term, because that's where I do most of my analysis. But we also keep a really close eye on the short term. This is actually starting to turn up a little bit after it had been flat, and it's going from positive to negative now. So this is also confirming that we're turning a bit more negative in the short term. But again, going back to this, we haven't really climbed enough yet for me to consider us going above the moving average. So I'm still saying that we're not trending for the time being. And we did pick up above average with volume because it was options expiration. So the VIX is going back up. The line chart is the closing value. We broke up above the moving averages and we closed a little bit off of the high here, but the bar chart is also above the moving averages. And when the VIX goes up, we see the VIX of the VIX also going up, both here with the bar chart and the line chart. So some fear is coming back into the market. And we're turning back up here with the MACD. This measures the momentum. What's the direction of the VIX? When the VIX is going up, stocks are going down. When the VIX is going down, stocks are going up. Well, we were going down on a momentum basis. With the upward move to 18.25, we're seeing the MACD turning back up now. We still get high readings here with the skew index. If you watched any of these videos before, if you're familiar with this index, this is a variation of the VIX, but it's calculated in a slightly different way. We're up into this red area. That just means the market is expecting some kind of a big move, but even going back into 2024, possibly even back as far as November, we've been up in this red area. So it's like the market is expecting something big to happen, but it just hasn't happened yet to take us out of this red area. And this is the consumer sentiment showing the blue line, which really dropped down. Just to give some context, there's a longer term look at this chart, and I also plot the 2-year yield on here. But folks are getting a little bit more pessimistic when looking forward. And they were doing that back in 2024. There was some optimism right after the election, and now they're seeing a little bit more pessimism coming in. And we're seeing a discrepancy here. This is another fear gauge that we look at, where when this goes down, that means fear is decreasing, and that's what we're seeing here. But then here's another take on a fear gauge, and this one's going up. So they're going in opposite directions of each other. And we're going up with the equity put call ratio, which is not surprising. People are hedging. And when the equity put call ratio goes up, that means they're buying more puts than calls, and puts are used to hedge your long-term positions. And we're seeing a bit of a contradiction where we're still going down with the 5-day chart, but we're going up with the 10-day chart. So shorter term, we're going down, which is positive, but longer term, this is going up, which is more negative. And we actually decreased here. Very surprising. Usually when we have a down day, the volatility risk premium, it will go up. We've been in this band, which is more neutral, and we actually declined in Friday's session. And the advanced decline line took a bit of a hit, but it's still positive longer term, both based on price and volume. We're dropping back below zero. We had turned positive with the advanced decline over 10 periods. We were going up. Well, with Friday's session, we're now going back down, and we've turned negative because we're below zero. And we were showing an improvement here with the new highs, new lows, and other internal measure that we look at. We're seeing a drop off in the new highs. Not really seeing much of an expansion of the new lows. It's more of a contraction of the new highs. We're still positive in the 5 with the 5-day moving average, but we are rolling over. where now with the 10-day average, we're starting to go back down where we had been going up. And we're declining, but still positive with the short and intermediate term advanced decline ratio. And we're coming down, disregard this indicator down here because it has us crossing below the moving average. And that's clearly not what's happened here. This is smart money indicator number one, where we were getting kind of far away from the moving average and now coming back down. This is still positive, but the context is that we're going down. We need this to, at some point, start to turn and go back up to become more positive. And we fell down and we're actually turning negative now with the chicken money flow. The histogram really dropped off and the red line is now going down. And after giving us a really, really high reading, the highest than what we've seen on this chart over the last year, the chicken oscillator, our third smart money indicator, is now dropping down, no longer extreme, and it's below its moving average. So we have two out of the three smart money indicators switched to negative after Friday. And we're just barely negative here with the vortex. If you look over here on the left, the green is 0.93 and the red is 0.94. So they're kissing each other right now, but the red line is just a tick above the green line. So that would be considered negative. And then the advanced decline line for the S&P based on price, not really moving all that much here. We did see a bit more of a hit when we break that out based on volume. And we are seeing the red line. This is the NYSE advanced decline line. It's coming down and starting to drop below its 50-day moving average as we're seeing the S&P come down. This is not an apples to apples comparison. This is the S&P 500 compared to the NYSE advanced decline line. They're related to each other. That's why I have the chart, but it's not a straight comparison of the two. We're just trying to see how they're interacting across a broader perspective. And then the NYSE cumulative advanced decline line did drop down below its moving average, but not all that much of a decline here. We've been chopping around, not really moving all that much with the regular NYSE advanced decline line, and we're still above a flat moving average, but we're still above that moving average. And then we break it out based on common stock on the NYC. We saw a decline based on price and volume, but volume was breaking out and setting all-time highs here and pulling back. We're just off of that reading where we have not confirmed that based on price. And I was picking this out as being more positive, that we're going up stronger with volume, hopefully meaning that that would lead price higher. Well, it hasn't done that, at least to this point. And we're seeing some weakness here with the advanced decline line coming right back down a little bit under the moving average with the NYSE common stock based on this study. We're declining, but still above the moving average with the S&P. So it's holding up a little bit better, coming down a little bit below the moving average with the mid caps and even showing more weakness here with the small caps. And then looking at the ratio between large caps and small caps, even though large caps got hammered, small caps got hammered even more. And that sent this ratio going up. And that just means that large caps are outperforming on a relative basis, even though everything got hammered on Friday. We're dropping back below 50 with those stocks inside the S&P above their 20 period moving average. So this is now turned negative. And longer term, we are seeing where we were tending to go up with the S&P, where this was tending to go down. That's a longer term negative divergence. And now we're going to be watching this. If we see more weakness down here, is this longer term negative divergence going to actually come into play and mean something? We've been noticing this, but if we could have kept going up with this study, that would have negated the negative divergence that we were seeing here. Now that we're going back down, that brings it back into play for something to watch. We're declining, but still above 50 with the 50 period moving average study, and we're dropping below 50 with the 100 period moving average study, and we're declining with the 200 period moving average study, but we're still well above 50. Short term, really hard to read here because we're coming up to February and we have the new pivot points that will be in here. And these last for the whole month. And I update this every day on the YouTube community tab. I have intraday pivot points and then I update this chart. Even though the pivot points won't change for the whole month, I update it with the bar for that particular day. And at the bottom, we are above average with volume here. And so we're declining in the short term, intermediate term, and long term. All the moving averages of the S&P are now going back down. And we're already extreme negative with the Stochk RSI. That means, according to this indicator, the momentum is now negative, where we're declining below the midpoint with the Williams percent R after being extreme positive, and we're falling below the midpoint with the CCI 14 and the CCI 20. So this had been hanging in there looking more positive. All these short-term indicators, now they're switching over and looking more negative in the short term. And we're dropping below the midpoint with the short-term stochastic. We're no longer extreme with the intermediate short term. We're still extreme positive with the long short term, but rolling over. However, we haven't crossed back below the moving average, at least yet, because it moves slower. We're negative with the force index and probably close to extreme negative since we're hitting this Keltner band. This is a variation of Bollinger Bands. And when we go down and hit one of these bands, that means we're going pretty fast in the short term. And we're still doing okay after Friday with our short-term trend. The lines, they're not rolling over, but if we stay below these lines are going to roll over, and that's going to turn the short-term trend back to even more negative. And we did drop below the 20-period simple and exponential moving average, where we've been holding out above that. Now, that's why I'm saying that we're negative in the short term. We dropped, we dropped below the midpoint and we're right on the border between the -1 and -2 standard deviation. Excuse me here. And so we had been positive. We were above the midpoint. We were even up into the +2 channel there for a while. Now we've gone down almost into the -2 channel. Then intermediate term, we're no longer extreme positive with the balance of power. It was giving us some pretty extreme positive readings, but it still has a ways to go to actually turn negative. But the context is that this is now going down. And we've gone from positive to more neutral to even somewhat negative with the go, no go. It turns to the lighter shade of blue when it's more negative. And we're dropping below the midpoint with our highest high value chart. We were hanging out around the blue line, which is the highest high value. Now we're seeing some weakness. And we were seeing some improvement with the TTM squeeze. We saw the lighter blue and it was going back up. Now we're seeing a darker blue that's going down. And this was kind of giving us a little bit of a heads up. The ease of movement, which tries to measure the path of least resistance, whether it's up or down. Well, we've been getting a lot of readings right around zero because we've been going sideways. And we started to drift below zero after Thursday, and now we're continuing to go down below zero even more after Friday. And the Arun is no longer extreme. It can go long periods of time and not tell us anything, and then it shot up to an extreme positive reading. And it's measuring buyers versus sellers. And the oscillator down here measures the difference between the two. This is now coming back down after being extreme positive. And we're dropping below zero with the S&P McClellan oscillator. We had been mostly hanging out recently above zero. That's positive. But then when this drops below zero, this impacts the next chart, which now we're starting to go back down with the summation index based on price and volume, where this had been flat out positive over the last couple of days. Now it's turning back more negative. And we're below zero with the broader market measure of the McClellan oscillator on the NYSE. We dropped below zero. It's really hard to see, but we're starting to roll over based on price and volume. They are ticking down a bit there. And this was another thing that we were looking at as possibly being positive. The Swindling Trading Oscillator was going up based on price. It was going up even more with velocity based on volume. Now they're starting to turn and go back down, but they're both still above zero. Momentum was starting to turn back positive, not after Friday. We're coming back down to the moving average with the PMO. We were showing an improvement here based on price. Now we're back at the moving average. We're still positive based on volume, but now we're rolling over. And so we're seeing a little bit of a weakness with the PMOs that are rising. We're turning back down with the buy signals where we had been starting to go back up. And we're still pretty much flat here with the PMOs that are above zero. We've gone from neutral to negative with the Elder's Impulse system for the S&P, but we're still positive with the parabolic SAR. We haven't seen enough of a decline to put the dot on top. As long as the dots are underneath, this is still positive. Now we see more follow through weakness, and you can see we're coming back to some previous lows here. If we surpass that and close below that, the dot might turn over negative, but for right now, it's still positive. And we were showing some improvement in the short term with our oscillator. This is the slope oscillator. We were actually back to positive with the MACD, but now we're starting to see some weakness. We're rolling over with the slope and TSI. Those are the short term oscillators. We were positive with the MACD, PMO, and PPO. Now they're coming back down to their moving averages. We still are positive with the tricks and KST, which are long term, but you can see we're starting to come back down to the moving average, especially with the KST. The Copic curve was just on the verge of turning positive. Now it's rolled back over and is continuing to be negative. And the Sean trend meter, it came all the way up into this dark, sickly green looking area, then dropped all the way down, and we're right on the border. If this drops below 60, this would be more in neutral territory. The reason why it's extreme positive is because we're above 60, but the context is that we're going down. And we were extreme just a couple of days ago with the ultimate oscillator. We're declining, but still above 50. We're also declining, but still above 50 with the money flow. We're declining, but still above the moving average with unbalanced volume. And this is a little more negative too. We've been hanging out with the RSI 14 and 9 pretty much above 50. Now we're starting to drop below 50 with both. And the 14 is intermediate term. The 9 period is short term. And we're not seeing much of an impact yet with the intermediate term trend, even though we're dropping below this blue and red line here. If we stay below this, then these lines are going to start to roll over. But for right now, the 50 period moving averages are providing support. That's where we set the low, and we were able to hold on to that in Friday's session. So that's positive for the time being, and that's why we're still positive in the intermediate term. But if we come down, and it's not where we go, it's where we close in Monday's session. If we close below this moving average, that's going to turn the intermediate term over to negative. And we fell below the 20s. Now we're down at the 50s, but the 100s and 200s are still going up. That's why we're negative in the short term right now. We were positive with the bullish percent index for the S&P, but no, we're going back down below the moving average now. So this has turned to negative. And we're falling below 50 here with the NYSE bullish percent index, and we're declining with the NASDAQ 100 bullish percent index. And we had come down and we're dropping all the way through the rainbow here. This is just a 20 period simple moving average of the open, high, low, close. Oftentimes when we're going up and we pull back, the one of these areas will provide support. That support was broken on Friday. If we continue to stay below all of these lines, the lines are going to start to roll over and go down, and that would be more negative. And this is could be part of the problem. I've been trying to point this out for quite a while now. We're back in December. We came up to the upper end of this trend channel, and we've really had a difficult time actually breaking through it with any conviction. And so now we're possibly coming back down. And so this is providing overhead resistance on a longer term basis. And we're turning more negative with the hike in ASHI. These are different ways of measuring the trend. We're still positive though with the Renko chart. The Kegi chart is black but pointing down. So it's positive since it's black but pointing down. So that's negative. And we're turning more negative here with the three line break. So we're seeing a mixed picture when we look at our trend currently this way. And we did see some weakness with the 150 and 200 period moving averages, but we've been pretty much range bound so far for most of 2025. And we're negative in the short term with all the different indexes, the S&P, the mid caps, small caps, and NASDAQ 100. We're negative with the mid caps and small caps. They're just not performing as a lot of people had hoped. And then we look across the broader market. We're negative in the short term with stocks. Bonds have switched back to positive based on price in the short term. Commodities, this is where some of the inflationary concerns are being manifested right now. Commodities are going up. The dollar was up on Friday, but it's still in a short-term downtrend. And we just had staples and utilities, two areas that are considered to be defensive. They were up, with staples being up the most. All the other sectors ended up getting hammered with tech, discretionary. These are two growth areas. And communication also ended up being down as well. Not a good day for growth. And so we're seeing kind of a Christmas look here with the red, with the Dow crossing below 44,000. Let's see, the Nasdaq went above 20,000 there right after the open, but then it went below 19.9, 19.8, 19.7, 19.6. The S&P went below 6,100 as I pointed out earlier. We're still above 6,000 though, but we saw some technical damage. We're seeing a bearish MACD crossover with the materials. That's more economically driven. We had the NYSE have a BPI cross below 50. I showed that earlier. And we had staples. This is showing strength. This is crossing back above 50, and that's more defensive. Now, we want to watch this to see, are we seeing something that's developing, or is this just something that happened for a day or two? And then we had a BPI cross below 50 with the NASDAQ, which I don't show that chart. And then healthcare crossed back above 50. That's another defensive area that saw some positive action on Friday. And we're seeing the weighted version of the S&P going down, and then the equal weight here is actually underperforming because the red line is underneath the bar chart here. We dropped below the 50-day moving average with the Dow after we had been just chopping sideways to going slightly lower. And I think I pointed out here that we were seeing a series of lower highs, and you could make a case for somewhat lower lows. Now we're definitely making a lower low here. And we're still negative with the diamonds. This is the ETF for the Dow. We fell below the 50-day moving average with the NASDAQ, and we're camped out right at this pivot point. This could provide some support. If we break through it, that's going to be more negative, where we're still above the 50-day moving average with the NASDAQ 100. If we continue to fall, is that going to provide support? And we've gone from neutral to negative with the QQQs, looking at the Elder's Impulse system. The momentum is still positive for the NASDAQ 100, but rolling over. And if we cross below this moving average, that will turn the momentum negative. And we did fall below the 20 period moving average for the triple Qs, but we're still above the 50 period moving average. Small caps just getting hammered, breaking below their 200-day moving average with the S&P 600 here. Never could stay above and close above its 50-day moving average. So now the blue line's rolling over, and now we're losing some pretty significant support here at the 200-day moving average. But there's a little bit of encouragement here. You look at the Russell 2000 small caps, they came right down to the 200-day moving average. And we came down here earlier in January and then bounced up off of that. Didn't really lead to much of anything. We got back up to the 50-day moving average and just stalled, but the market used this as kind of a launching point to go higher. Is that going to be what happens now? Now, if we fall below the 200-day moving average, yeah, that's going to turn things more negative. And we're negative with the Elder's Impulse system for the small caps. We're also just a little bit above the 200-day moving average with the mid caps. We're wondering if that might provide some kind of support to bounce up off of. We're still negative with the mid caps when looking at the Elder's Impulse system. The broad market, we did fall below the 50-day moving average. Now, that's happened recently before. We're still in a longer term uptrend, but if this continues to go down, that's going to be more concerning. And we're also just about on the 50-day moving average here with the total US stock ETF. And I'm trying to look over here. The moving average is at 131.66, and we closed at 131.36. So we're just about on top of the 50-day moving average. And the financial sector, which has been strong, when you look at this chart all by itself, it got hammered over 1.5% on Friday. And we're actually falling below the 50-day moving average with the FANG index, which is just coming off of a recent all-time high. But the longer term trend is still positive, and we're breaking below this longer term trend line here. Now, we've broken below it before, and we were able to bounce up off of that. But if we see more weakness here, that's going to be more concerning. And these are the big stocks: Facebook, Apple, Amazon, Netflix, Google, Nvidia. And then Apple was virtually unchanged, still above its 50-day moving average, where Amazon got hit 2.83%. And Microsoft was down 1.9% in a downtrend below its 200-day moving average. Hold it, I guess that's somewhat of an uptrend there, but it's below its 200-day moving average. Google was down 2.65%, still above its 200-day moving average. Meta, after setting some recent all-time highs, pulling back 1.62%. Nvidia coming back down, it was down over 4%, but it's at its 50-day moving average. Tesla, which has been getting hit, and this is why discretionary has been underperforming. A large part of discretionary is Tesla. Another large part of discretionary is Amazon. And then we had Netflix setting an all-time high, but down over 2%. So some of this could be counted up as profit taking, but we want to keep an eye on this to see if the overall climate is shifting to more negative. And we look at US versus world stocks, still seeing kind of a leveling off here, the short-term correlation and the longer-term correlation. Oil is still falling. We're getting into the low 70s now, and the dollar is underneath its 50-day moving average. That's why it's negative in the short term, but intermediate term, the 50 is still above the 200, which is an uptrend. And then we look at bonds, which are falling down under their 50-day moving average and falling below 4.5%. So that's actually positive for the market. And then here's the intraday, where we camped right along this 4.5% level here on Thursday, and then we're able to break below it. It actually acted as overhead resistance here, and then we broke down below it. So that it wasn't treated as positive on Friday, but if this stays down below 4.5%, that could be positive for stocks. And we're going up with the 10-year based on price. We're keeping an eye on the 10-year yield in Japan. That just continues to go up. It really mattered last summer. It's continuing to go up here, and so far it hasn't mattered all that much. And we're seeing some weakness here with our growth to value ratios, with the Qs to S&P. Discretionary just really not doing well compared to the S&P, falling below the moving average when we compare large cap growth to value. And so the large caps are below a declining moving average. The mid caps are just getting hammered, as are the small caps with their growth to value ratios. And we're seeing staples really spiking up here. Now, the overall trend has been for this ratio to go down. That means the S&P is outperforming staples. If this continues to go up, that'll probably mean, like what we saw back in 2022, if the overall trend of this is up, that's negative for the market. We want to wait to see what develops after this. All right, so what's our outlook? We are negative in the short term and we're still not trending. We're not going to have any economic reports on Monday. And then anything geopolitical that happens or political that happens in the US to freak out people or freak out the markets or anything like that. And then here's the economic calendar for the upcoming week. We will get consumer confidence on Tuesday, and there's nothing on Monday. Wednesday's kind of a sleepy day too. And then we'll get initial jobless claims and then the second reading for GDP. Now, we've already seen this number once. We're going to see it again in the upcoming week. And then the big inflation report in the upcoming week is going to be on Friday with the personal income and spending and core PCE. That's what the Fed really likes to watch as far as gauging inflation. All right, so nothing happening on Monday, consumer confidence on Tuesday here for the economic reports. And we're neutral to negative with the Dow and the NASDAQ for February 24th, where we're just flat out negative. So on a seasonal basis, things don't necessarily look all that great either right now. And we're now going into the second half of February, which tends to be negative during whether it's a regular year. We do see a little bit of a bounce during a post-election year. That's the green dash line, but then this typically is an underperforming part of the month. And this is the second half of February, which tends to underperform. There's also the second half of February. February tends to be the weakest month during a post-election. We see that on this chart as well as on this chart. So now a lot of things that were on the positive side are now switching over to the negative side. We're still positive with accumulation distribution, but we're pulling back. Where the Chaikin money flow, the red line's coming down, and we're declining with the Chaikin oscillator. The 10-day equity put call ratio is still going up, which is negative. Going down would be positive. And we switched over to negative with the McClellan oscillators and summation indexes. And the Copic curve was trying to turn positive, but now has gone back to being negative. The Swinland trading oscillator, which had been positive, is now negative. The vortex, the red and green line that we're kissing, the red line just barely above. The bullish percent indexes are turning negative where they had been positive, and our momentum oscillators are declining and turning back negative after they were actually turning back to positive. The ease of movement is negative as well. And then the positive side, now we're still hanging on to growth to value being positive. We want to see where do we go from here. If those ratios continue to weaken, then we might have to switch over to a negative stance. The same thing is true with discretionary to staples. It's still in an uptrend for right now. And the equity put call ratio for 5 days is going down. The advanced decline lines are still positive, but they're weakening. The parabolic SAR continues to be positive in the money flow, but it's declining, as is the ultimate oscillator. The financial sector is still positive in the bigger picture, and the momentum for the NASDAQ 100 is barely hanging on to being positive. So our conclusion, we are negative in the short term, but we're still positive in the intermediate and long term, but we're still not trending. So in the short term, we're negative but not trending. In the intermediate term, we're positive but not trending. And for right now, the 50-period moving average is holding. In the long term, we're also not trending there either, but we continue to be positive. Thank you. I hope you have a great weekend, and I will talk to you in the next video.